Hi, thank you so much for staying to the end of the program today. So I'm wrapping up with the very last panel discussion for the day. So today we are discussing more about the passive and as well as active ETF. Because historically we have known that ETF are actually very boring stuff. They are just index hugging benchmark, and they are not supposed to like have any smart Alex managing all these funds. But recently the first active ETF has been listed, even on SGX as well. And we do see there's actually a lot more active ETF these days compared to the earlier times. So just wanted to bring this question to our panel. Like perhaps you could just brief us for a start. Let us know what's the difference between the active as well as the passive ETF. Is there like any unique characteristics and so on? So I'll just go down, maybe one of you. Yeah.
Sure, I can start first. So quick intro, my name is 𝗪𝘃. I'm from Singapore Exchange. I'm the ETF product manager. So as shared earlier on, we have recently launched active ETF in Singapore. That was in end July, the first ETF that tracks, it doesn't track an index because they're active ETFs and is focused on Japan equities. So what's the difference? Before I go into that, maybe the common similarities between passive active is both are traded on the exchange. It does allow the flexibility to buy and sell during the trading hours. And to a certain degree, it also has the cost effectiveness because it does offer a lower TER, total expense ratios, compared to unlisted funds. So what's the differences is, of course, active ETF is actively managed, meaning that it doesn't seek to replicate performance returns of any index. In fact, the one that was launched in January, although there is a reference benchmark topics for Japan equities, but it doesn't really seek to replicate, already doesn't really seek to outperform the benchmark. The objectives of the ETF is to provide a long-term capital growth. So I think one of the important thing to note when you're looking at active versus passive is really for active ETF, understand what is the objectives, what are they trying to achieve, the market they're investing into. Because there is no specific benchmark that they're relying on, one needs to be very sure about what is the investment strategy of the issuer.
So, maybe 𝗪𝘃, you can share a bit more.
Okay, right. So for myself, introduction again, I'm 𝗪𝘃. I'm a research analyst with the iFAST research team. Of course, I think 𝗪𝘃 highlighted the very good, the key points of passive and active ETF itself. I think most importantly, I think the idea is more control is given to the fund manager of active ETF management, where they are able to make a lot more discretionary decisions in how they want to manage the fund itself. Of course, aligned to the underlying objective that 𝗪𝘃 had previously mentioned. Some can be going for additional alpha. They want as high returns as possible, whichever they can get from the market. But of course, some of the others you can identify from the market is like, oh, we are trying to lower the volatility exposed for investors. So at the end of the day, there is very important distinction for the investors to make, whereby they really have to see the underlying objectives of what the funds are trying to achieve, especially so for the active ETFs itself. And of course, highlighting on the exchange traded structure itself, this is a very huge plus when we are comparing between active ETF versus active funds. That means your unit trust, these are actively managed funds itself. You have this additional liquidity you can get in an intraday. Whereas, of course, unit trusts are typically also quite liquid within days, but of course, the liquid in the day itself can be an additional good point for investors.
Yeah, hi, I'm Kenny. I'm the investment director at iFAST. I'm actually a fund manager. So actually, ETF is competing with my product. So I thought I could bring you a kind of perspective. I would say that for most investors who are looking for a lower cost proposition, passive ETF would be a good way, especially if you want to allocate your money to the bigger markets like the US and the global scene. So in that regards, a passive ETF whereby you replicate the index, it may be boring, but as you know, even how boring is the US is still returning you a very good return. In fact, ironically or embarrassingly beating a lot of the active funds out there in the market. So I think to me, cost consideration is one of the most important aspects of investing in passive ETF. For active ETF, some of you may be looking at certain themes, for example, like for example, if you like the kind of the AI or even some of the technology kind of theme, then there are also active ETF out there whereby you can position yourself as more like a tactical play to make the extra return. As what 𝗍𝗻 has mentioned, they are mostly actively managed. So as a result, they are not trying just to replicate the benchmark, but to beat the benchmark because they are charging you a higher fees. So there are a couple of good ones out there. So which you may be able to look at in our ETF focus list too.
Yes, so thank you for sharing the differences. So I guess active ETF is like a marriage between unit trust and an ETF, but probably the best of the both qualities, like liquidity as well as the active style in the management. So actually, because this year, as in recently we saw the SGX with the active ETF listing. Maybe this question just for 𝗪𝘀. Maybe could you just share with us more like, how would this actually affect the SGX market? I mean, the ETF market. Will we see probably more active ETFs in the future?
Yep, thanks. Certainly, I think that it's a good start of the year that we finally have the first active ETF in the market. It's certainly not something new globally. Those of you who have looked beyond Singapore, you notice that it's on the rise. Active ETF, as you have rightly mentioned, is a marriage between active funds and the ETF. So the success of active ETF globally is really due to the flexibility that it offers to investors that previously they don't have to, right? In the past, active funds can only be purchased through a particular platform or distributor. Today, through the platform, in fact, on FSMOne trading platform, you could easily access it on your fingertip. So we are going to see more active ETF coming out. We are in conversation with a lot more issuers who have shown interest in launching active ETF. So certainly that deserves some attention. And we do also believe that investors, with the introduction of active ETF, will have more to deploy your portfolio monies. And I think that's a natural progression, certainly in the fund scheme.
Okay, that's interesting to hear. So I guess we can keep our eyes peeled for more active ETF on the SGX market. Something very interesting, whereby actually a lot of active ETFs are overseas, in fact. So actually, when we come to think of the word active, right? Actually, these two things always come to our investors' mind. One is fees, and another one is performance. So I understand just now you guys shared a little bit about the fees, like how it affects because it's active, it's still slightly more expensive than the passive ones. But comparing this to the traditional mutual funds, are the fees generally lower? And also, what are the merits between the traditional funds and this active ETF fees? Like, why should we pay more for the funds, or why should we go with the cheaper ones?
Yeah, maybe I'll take this on since I'm an active fund manager. So basically, for a lot of the UT out there, like it or not, the fees will be generally higher. So I think if you look at a lot of the UTs, you're paying anywhere between 1 to 1.5%. Whereas if you look at the active ETF, so they have the elements of active management, but yet I think you're talking about fees more in the range of about maybe 50, 60 basis points or some even lower. Whereas for the passive one, which will be cheaper and typically they could be below 10 basis points. So I think that give you a perspective of the kind of trading costs or management costs.
Right. So I think I can come in to comment on the performance, but since that is something that we do see actively when it comes to research itself, of course, I think my answer will be a bit more towards yes and no when you see an outperformance from in either way you want to see it. Because underlying, it depends on the investment objective of the funds itself. Of course, on one hand, we are more obsessed with returns. Oh, how is the returns on this fund, returns on that fund? But sometimes underlying the fund itself, there can be important underlying objectives, which is previously I mentioned, sometimes it's about risk itself. Some managers and some investors itself, they want to limit the risk that they're exposed to. And typically this is also achieved by managing and limiting the volatility overall on the funds itself. So coming back at the end of the day, a very important understanding on investors' part, right? Rather than just looking purely on returns, to understand the investment objective itself and understand where the fund managers are targeting towards. And this applies for either of the being active ETF, passive ETF, or even coming to the unit trust itself. These will be very important considerations for investors. Yeah, I think that's a more important message for my side.
Maybe just one point to add also for active ETFs. One of the differences that it has from active ETF and active funds is there's also some degree of transparency. Because all we know is ETF, right? ETF, there is always something that investors like is about its transparency. In fact, for passive ETF, on a daily basis, on issuer websites, you should be able to see what's we call the portfolio composite file. So assuming STI ETF, you know what are the 30 stocks. If it's MSCI China, you know what's in the universe of MSCI China index on the issuer website. And come to active ETF, certainly we allow some degree of delayed disclosure, but that's up to 1 month. So in a month's time, you will also know what's exactly in, let's say it's a Japan equities, active equities ETF. Within a month's time, you also know what's within the portfolio. What are you holding? And then that's very important because when you're investing, you want to know what you're buying. Certainly, the reputation of the fund manager, the portfolio manager, their track record plays a big part. But more importantly for investors, even when buying into a fund, is certainly an added-on advantage if you know what's exactly in that 30-stock portfolio or 50-stock portfolio.
Okay, thank you. So I guess we can summarize all this as, for active ETF compared to the actively managed mutual funds, you know all the granular details of all the ETF components, and the fees actually are not exactly everything, neither is the performance as well. I think it's most importantly to understand the investment objective of each funds, be it active, passive, or mutual funds. So now that we have a greater understanding of this passive and active ETF, probably we can apply this knowledge, on our day-to-day investment when it comes to constructing our portfolio. So would you recommend just choosing like binary option, like I can only choose active in my ETF, or should I have passive, or should I have a combination of both? Yeah, maybe could share more.
I can go first for this. I feel like definitely a combination will be advised, as with every other answer, that we prefer to go with both rather than just a yes or no. I think ultimately when we look at the markets, right, you can really see that some markets are quite efficient with a passive method. Meaning to say more of the ones that we are used to, like US or the overall world, is a little bit tilted to more US. But some of the other markets will probably require a little bit of active management when it comes to funds, because you do understand some certain inefficiencies, whereas sometimes it might be the index itself, sometimes it might be the market and the stock exchange itself. So having this understanding, right, then you can create this mix and match to see what is your ideal portfolio from there. Of course, here lies the caveat that information is very important here. You need to have the knowledge of which markets that you really want to go into, and which of these markets, which one might be a little bit more suitable for with a passive approach, or might be better with an active approach. Of course, currently with what we understand, for example, China requires a lot of judgments that is keen judgments, depend on keen insights from the fund managers itself. And sometimes fund managers have this additional access to certain information. And that's where an active approach, be it ETF or unit trust, comes in very importantly, because they are able to have that judgment before the market, react to the information itself. So I think ultimately a combination will be very important, especially when you're considering different markets that you want to go into.
Yeah, if I may add, as I mentioned earlier, if I have $100, I think, and I'm going to allocate, a significant chunk into, let's say, developed market. So most of the developed market, I would try to, put in passive ETF. I mean, if you want to just construct an ETF portfolio, and I think that will minimize your cost. And I agree with 𝗍明, some of the more emerging markets, there could be certain teams or there could be certain inefficiency that you're trying to exploit. So an active ETF in that regards may be able to exploit some of these inefficiencies. So that part, I think, can be fulfilled by the active ETF in your portfolio. So a combination of both would be a recommended strategy.
Just one point to add, I think Certainly when you're constructing a portfolio, by doing that is already an active investing. So you're actively selecting the ETFs that you want in a portfolio, be it passive or active. So going back to the first point, I think it just need to know what's the investment objective of each ETF you're holding. What's the purpose? Are you trying to build a core equity? Would a S&P 500 be sufficient? Are you looking to add more asset classes? I think there was a very probably pretty interesting sessions earlier on bond ETF, gold ETF, REIT ETFs. These are basically building blocks, right, for your portfolio. So for those who want to keep things simple, overanalyze on whether that strategy is going to work over the long run. You think that passive works? I think by all means, nothing wrong to have a full passive portfolio. However, if you do have the same belief as what the fund aim to be outperform. For example, the recently launched ETF has an AI-powered model. So if you are interested to participate in AI fund management, you think that AI might be able to deliver outperformance, I think nothing wrong having some allocation, just to see whether that helps you to achieve some alpha. But end of the day, I think whatever you're doing, if you are choosing your ETF, that is already a form of active investing.
Yeah, very interesting insight from all of them. So maybe to drive home to the point of our ETF team today is actually to achieve financial independence. So just one last question to all our panelists. Just one, maybe to conclude this, could you just share one tip, how can we use ETFs and also other investment products to actually grow our wealth and to actually achieve financial independence?
Yeah, maybe I'll start with that. I think financial independence mean different thing to different people. So I think the main starting point, you just have to be true to yourself. What are your financial goals? What is your investment objectives? So I think that is an important starting point for you to build a portfolio, at least on the investment part. I think financial independence would include more than just investing, because I think it also include your expenses. So having a budget that you actually tracked, how much you are coming in every month, how much is going out, what are the excesses, and how you're going to make more out of your excesses that you can save. You can also invest in the portfolio. So on the investment part, I think that is something that you just have to be understand your risk tolerance level, understand your investment horizon, and understand your investment objective. I think then you can actually plan on the investment part of the portfolio. And then of course on the or those that are closer to the retirement age, I think the Singapore government also have this CPF Life, which I think is coming from a financial background for more than 30 years, I think regardless of whether you feel that the money is kind of trapped, but in reality, the kind of payout, you can't get it elsewhere outside the market. So I think that is also something that you can set aside and consider for part of your retirement planning or financial independence planning.
Sure, maybe I can start add on to that. So I think for those who are very new to investing, and I think some of you are here because you see ETF as a good way to start investing. Emergency fund, as Kenny mentioned, I think a safe is good to have that first, 3 to 6 months of expenses. Insurance is important as well, right? Because if you want to be financially independent, you need to make sure that on rainy days someone is on your back, have your back. And then of course, beyond that, if you are really thinking about what to buy, when to buy, RSP, regular savings plan, is a good way. I think now FSMOne have over 100 ETFs available. I think that's something that each of you, if you are really uncertain of market timing, you are not the active investor type, I think that's a good way to get started, set aside a budget and going through a RSP plan to invest for the long term. And in between, if you do hold some views in China, in bonds, in certain asset classes, then do some active management in overweight or underweight some of the ETFs.
I think they really covered everything. But I really love what Kenny and Wei-Jin really said. So especially for Kenny, being truthful to yourself, this is very important when you're doing planning for yourself. You need to really know what you want and what you have, and you know what you really are planning for in the future. This is where you really need to understand all your options there are. Because coming at the end of the day, having so many things out there, I don't really think there are any bad financial products in the market. Ultimately, it's just potentially at the wrong purpose at a particularly wrong timing. So we want to avoid that situation as much as possible for you, to attain your financial independence, for you to attain your financial goal. And the only way through that is you have enough of an understanding of yourself. So sit down with yourself, sit down with your financial advisor, sit down with people, your family and friends, to sit down and plan for yourself. I think that will be very important if you really want to attain financial independence. Yeah.
Thank you so much for all of your sharing. I guess we have taken on very good insights from about active and passive ETF and learning how to actually grow our retirement nest egg and also build our portfolio. Yeah. Thank you so much for being here today. I'll pass the time back to the MC.
Thank you.